Everyone, welcome. My name is Sasha Moore and we're here today with Chris Levy, SMSF expert and partner at Aquilis Super to hold the Super Update, What You Need to Know for 2022 live webinar. But before we start, here's a little bit about Chris. Chris has a Bachelor of Comms from ANU. He's a chartered accountant, a registered SMSF auditor and recognised as an SMSF specialist auditor with the SMSF Association. Chris established Aquilis Super in 1997 in response to the growing demand for an independent accounting practice that could provide specialist audit and compliance services to SMSFs, and is now responsible for audits and business development. I'm delighted to moderate this tremendous event. We're holding this webinar to unravel the red tape explosion and provide SMSF advisors, accountants and auditors with a greater understanding of the significant changes to the ATO and ASIC regulations and what this means in real terms to both firms and clients. Chris will delve into the technical detail and provide practical commentary on the major developments that will significantly affect the industry in 2022. We also encourage you to feed it through any questions you have for Chris via the chat function, and we'll address these at the end of the session. So Chris, over to you.
Excellent. Thank you, Sasha. And look, welcome everybody to this fascinating topic of red tape and self-managed super funds on a Thursday morning. But before I get into it, though, I might just give a quick, not so much an overview, but explain the reasoning why we're having this webinar, and I think it might be useful for all the attendees to to get the most out of it. And I guess on that note, this is not one of those quarterly super updates. It's very highly technical. We wade into the legislative changes. Look, there's a lot more smarter people that do that, and I love those things, but that's not what this is about. The genesis for this webinar really came about because what we were finding as auditors is that we were addressing this, or sort of having the same conversations and addressing the same questions with accountants over and over again, and it sort of got to the point where it's like, well, there's this gap in knowledge on a couple of topics that, quite frankly, we thought had been bedded down, but yet we just having this repeated conversation. So look, we've tried to put those questions and those issues that have arisen from the red tape into this webinar, and I guess as an attendee, hopefully you can sort of be aware of what, you're probably aware of most of this content, but in terms of the problems that we as auditors are having, or where it's falling short of what the ATO and ourselves as auditors are having, and just, I guess, make the whole process, having an SMSF engagement, just run a lot more smoothly. And that's particularly important because, let's face it, the deadline's only 2 months away, and having to go back to to an accountant who then has to go back to a trustee and say, oh, look, I know you desperately want this job done. We've got extra things we need to do. So let's get into the main meat of the topics. And the first one, and again, I'm a little bit embarrassed about having to talk about this, is valuations. Look, we thought that it was all kind of under control last year, and most people were across it, but we're not experiencing that. Look, I have to say, a large minority of work that we're receiving, valuations that are coming through with self-managed super funds, accountants are still doing they're not providing valuations, or they're not meeting the requirements that the ATO have now put in their guidelines, and or alternatively, accountants they're aware of some changes, but they haven't actually read through these guidelines, and therefore what's been provided is falling short. So, just very quickly, where this has come from, where the ATO they updated their guidelines, and I think it was about 2 years ago now. So it's getting a bit long in the tooth. And for anyone that hasn't actually read it, I strongly encourage you to do so. It's a 5-minute read. It's easy reading, and it's very well written. It's not a lot of jargon, makes a lot of sense, and it just provides a bit of scaffolding, a bit of extra support to your understanding what's required for these valuations. And then let's have a look. Now, what I guess the main sort of thing that we've found, I mean, the valuation guidelines, they're to be used for a whole range of different things. Benefit payments, the sale of property to related parties. We have to get a valuer, but the vast bulk of what we are doing as auditors, and I imagine what accountants are having to deal with, is the end of year financial statements and the valuations that go behind that. And one of the key takeaways from the guidelines, and there's a common misconception that you have to get a professional valuer in, you have to get a real estate agent in for things like property, and it's actually not the case. And the ATO, they word it very well, and they say when it comes to the year-end valuations, and they say it is usually the valuation process undertaken rather than who conducted it that governs the acceptability of a valuation. In all cases, the person who conducts the valuation must base their valuation on objective and supportable data. And those last four words are critical, objective and supportable data. And so to some extent, what it does is it gives the power to support the valuations, not necessarily in the hands of a professional, but a trustee can do this, or an accountant can do this. But so long as the methodology is really solid and it's got these solid data behind it, it's going to get it over the line. So that's the first thing I'd say. You don't necessarily need to have a professional valuer. So look, just keep that in the back of your minds, when you come to do these things. So in regards to the valuations, what we've found is that they tend to come into four different categories in terms of the issues that we're having. And there's the one basic category, which is residential properties. I mean, the lion's share of valuation issues or valuations that we're seeing relate to residential property. And look, fortunately, there's a reasonable understanding of what's required for residential property, and yet we're still having issues. And these sort of issues they manifest in a number of different ways. It might be, for example, that in many cases there's no valuation that's been done for a couple of years. It might be a real estate agent that's done the valuation but hasn't put the comparable comparable data in there. Some other comparable sales to support their valuation. They've essentially done a couple of lines and said, look, I looked at your property. This is how much I think it's worth. Line, not even close. And again, because there's a lot of publicly available information, particularly online, especially the core logic, that's been very useful. A lot of accountants have started taking that up and relying on core logic valuations to help get their financials done. Where there isn't that initial valuation in the working paper files, and we go back to the accountant and say, look, you need to provide extra info. Typically, an accountant and or a trustee working together can actually go out and obtain this information. They can look online, and they can, particularly in the major cities, they can find recent sales of a comparable nature to just add that extra weight onto the valuation. Comes back to the auditor, and we can get it over the line. So where we get those deficiencies, it's fairly easy to solve. So that's the basic valuations, or the basic sort of category. The next three categories are what we sort of tend to call more complex. And the first one is commercial properties, business properties. And I think for most of us, they've been somewhat of it's always been a little bit of a problematic area. Now, part of the reason for that is because there typically isn't publicly available information on commercial properties, or certainly nowhere near as easy to find. And what's more, a lot of these commercial properties, unless they're sort of office suites, they can be quite specific. There might be a bakery or a special factory, and the value is very difficult to ascertain. Now, what we are seeing, these working papers are coming to us with no valuation, or maybe one was done 5 or 6 years ago. And unfortunately, what we have to do is to push back on and say, look, I'm sorry, we need a valuation for this thing. And so and that typically will involve a professional. there's no easy way for a trustee to get over the line. And I might just point out that yield analysis, in the old days, I think there was people who used to use that, not so much anymore. And I don't believe the ATO accept that either. So in that instance, we have to push back, and there needs to be a value involved. And obviously there's cost, but then there's time, and it just slows the process down. So I guess the takeaways to my accounting brethren is to when an engagement kicks off, where a trustee hasn't got a valuation in the last couple of years, is to actually go and get them to go and tell them to go and organise that valuation. And look, there is definitely some pushback. Some trustees, they complain and look, it's my money, why am I having to do this? Unfortunately, I think that it's just the cost of doing business, or cost of a self-managed super fund investing in a business property. And look, just as a corollary to I might just briefly talk about where you have a related party tenant, and I have to say that's probably I strongly suspect that's a high risk area for the ATO. It's certainly a high risk area for auditors. And in that instance, the obvious sort of risks are that the rent being paid is too low, and effectively the fund is propping up the business, or it's too high, and then you've got all sorts of gnarly issues, and there's almost trying to circumvent the contribution rules. Or alternatively, they just think it's reasonable, but they've got no evidence to support that. It makes sense that when trustees are organising these valuations for their clients that have these commercial properties, where there's a related party tenant, I strongly urge you to also, you might even have to get involved yourself and tell the real estate agent, look, please also give us a market value assessment of the rent. And in that market value, market rate assessment, also factor in, look, is it inclusive or exclusive of GST? And is it inclusive or exclusive of outgoings? A lot of the stuff that we're seeing, it doesn't talk about that. And in many instances, the outgoings can represent a fairly sizable portion of a property expense. So it can change things. In a perfect world, all that will be spelled out, and just provide comfort. It just it basically means that the compliance issues that come with having a related party tenancy can be sort of put to one side, and you've done the best case on that. The second category, which we don't see a lot, and in many ways I'm quite surprised that we've had this, is where there's zero comparable data whatsoever. We've had some instances with residential property away from the big cities, out in these rural places where no house has been sold in the last 5 years. And look, that can be challenging. The accountant and the real estate agent involved just said, look, we'd love to help, but we've got nothing. Now, what we've had to do in that instance, or what they've been doing is, partly sort of pushing the net further afield to sort of towns that are close by that may have had some activity, but then also looking at sort of the underlying what's happened to the property prices generally in those areas, and applying some more broader analysis, I guess, sort of saying, well, look, overall in this regional area, prices have gone up 10% in the last year or two, and applying that. And look, granted, it's not as solid as having that comparable sales, but it's better than nothing. And typically what we've found is that these super funds, they haven't valued the property for 20 years. It just sits there at cost, and let's face it, that's not acceptable anymore. So be mindful that you may encounter something like that, but there are ways to overcome those challenges. Now, the final category, which is my favourite, are the non-property investments. And needless to say, even though the lion's share of valuations we're wrestling with are property related, plenty of funds have these unlisted trusts that do property development and commercial properties and whatnot, or startup ventures, or private companies doing all sorts of unusual things. The valuation rules also apply to them as well. They're not outside of that. And again, typically, in most cases, this work is coming to us, and with no valuation well, in some cases, no valuation even being attempted. And it just slows down the process. We'll have to go back and say, look, sorry, we need some figures to support the values in the balance sheet. And this can be very frustrating for accountants. I mean, the typical question we're getting is, look, how do we solve this? How can I give you a value for this entity? And fortunately, there's a whole bunch of different ways of solving it. Within the ATO valuation guidelines, there's actually, it implicitly suggests that you can also use there's another separate set of guidelines, valuation guidelines, but for tax purposes. And within that, if you go and have a look at those guidelines, it's excellent, and it gives a taxpayer multiple ways of coming up with a tricky valuation. For example, they can use an income-based approach, which is essentially just bringing forward the future economic benefits, your classic sort of discounted cash flow type methodologies, or it can use a net asset-based approach. So yeah, there's a bunch of different ways of doing it, and typically these types of techniques they're right up the skill set of accountants is perfectly suited to solving this this dilemma. And what we have found is when we explain this to accountants, say, look, this is how you can solve it. They can typically go away and they can talk to the directors of the trust company or the startup, and they can actually put some meat on the bones. They can actually go ahead and say, well, look, this is our future projections of income, or alternatively, if it's a property development one, they can typically add some values. And I'll give you a good example of this. We had one where there was a property development entity. I mean, it's a whole bunch of investors, and it was represented a very sizable portion of the fund, and we wanted a value. And after discussions with them, what they went away and did is they got a proper valuation of the underlying land, which had moved significantly from when they first bought it. And then, there was the actual cost of construction, which at that stage was only about 30% of the way through. And in the end, we had to revert to cost. And look, granted, it's very tricky. I mean, who's to say what a 1/3 completed skyscraper was worth, but there was a high probability of actually getting to the end stage. So we thought that was valid. So by merging the change in value of the by getting the change in value of the underlying property with the cost, you can actually come up with a realistic value. A year later, though, that construction had gone from 30% to basically close to finish, like 95%. And at that point, again, they engaged a proper valuer to come in, and they looked at the sale prices of all the units they pre-sold and what they were going to be selling the rest for. And so that, again, completely changed the methodology, but it allowed a value to be obtained. And I guess what I'd be sort of suggesting to accountants is before, we have one of these tricky investments, and most accountants do have a couple of funds that do invest in unusual investments like this. Before it comes to us, you'll have to have that conversation with the trustees and say, look, we need to get some proper valuations here. Here's how I suggest it be done. And again, perfect world, comes to the auditor, there's discounted cash flow models, and it's all mapped out, and there's a bit of weight behind those reports. A little bit of effort, granted, but and then that will allow the audit to go through quite smoothly.
So Chris, I think you've raised a really good point there. And before we move forward to SuperStream, perhaps you can give some insights from an auditor's perspective of what can help whether it's a valuation or whatever description, travel a little more smoothly.
Sorry, Sasha, what do you...
So what advice would you have for accountants to help that valuation process run smoothly? So you mentioned speaking with the clients and so forth. Do you have any other tips?
No, I think that's basically it. I think that the key takeaway for accountants is to be aware that this can slow the process down. We can't budge. The rules are very clear on this. Trustees have had plenty of time to get used to the new rules, and so what ends up happening is, well, what we want to try and avoid is the the audit just stopping. Like I said, 2 months away from a deadline, we don't want that. So in the first step is, engage with the trustees and try to, whether it be engaging a real estate agent, whether it be coming up with a valuation for a private trust, do that as part of the normal work for the fund, so that when it comes to the auditor, everything's there, and and hopefully it can just be sort of ticked off, I guess, and the audit can be sort of can just press ahead. So yeah.
Sounds good. Well, we might move on to the next topic. So I know that there are a lot of challenges with superstream requirements. So let's maybe get our teeth into that.
Yep, sure. Look, when I first started this webinar, I thought, well, look, this might be a couple of minutes, and just talking to a lot of accountants. Look, some have haven't had any problems. It definitely does add a little bit of time to to rollovers, to wind ups, and in the feedback I've had, in at 85% of situations, there's no problem. All the ducks line up and money just flows between say the industry fund or the self-managed fund, and vice versa. It just works. For those 15%, where it doesn't work, it's incredibly difficult. It's incredibly problematic. And I guess look, I'll give some examples before I do that. I might just, for those that aren't aware, I mean, superstream, as most people are, understand. I mean, it's essentially the ATO, they in order to maintain the integrity of this whole the superannuation system, and basically not have superannuation monies get pilfered, cybercrime and all that sort of stuff. They tried to make this kind of enclosed environment where they could, everything was super secure, and you wouldn't get this, this loss of funds through fraud. And so what you've had, initially I thought it was a case of, your retail industry fund, your self-managed super fund, the tax office in the middle, and they just all talk to each other. And look, that is basically what it is, but there's about 6 or 7 databases that all kind of work, and I mean, where there's a rollover from one fund to another, you want to use half of them, but there's multiple ones there, and it seems to be that they all need to be perked in order for it to go smoothly. Now, the sort of problems that we've seen. The first one is that like if the name's not quite right, or if we get some Australians that like that they might have unusual names, or they use a different name for their personal tax return compared to what's on the superannuation fund. With the ATO system wherever you get little problems like that, the whole thing can just slow down. And one of the biggest issues that we're finding, and other accountants are finding, the superstream process is there isn't a kind of a dashboard where someone can look at and say, look, your error's here, you need to fix that one up. All you get is a rejection notice, like an error, and then and typically it falls on the accountant to have to go and chase it up, and that's what's happening to these 15% of instances where there's a problem. And I guess to give an insight into the sort of the finicky nature of where things can actually go wrong, one of the key things is the bank statement details, or the bank account details. One of our good clients, they were having tremendous problems, trying to work out where the issue was. And the ATO was saying, well look, there was a failure between the super fund database and the ATO database, and it's just an error. And so the accountant was talking to the ATO and repeating the details, and they're still getting this error. And the ATO was saying, well, no, everything you're telling me is matching, what's in our system matches what you've got. And then on the ATO person thought, well, hang on a sec, let's have a look at the bank account. And the bank account sort of section or field within the ATO database only, for example, went for about 16 characters, whereas it was 20, 25 characters over on the on the BGL or class software. And So what was happening, it was the ATO system was cutting off the last couple of letters. Those exact details, those 16 characters, had to exactly match what was happening over here on the, within the SMSF software. And what's more, where accountants typically abbreviate bank accounts and all the rest of it, you can't do that. It has to be exactly the right length and the right words. Otherwise, the thing falls over. And I mean, this was not the ATO, working through like an instruction manual. It was just guesswork. It was just guesswork to try and find the error. And so, you can see it's a very delicate system, and you have all sorts of problems. Now, before I give some more examples as to real life problems that have been created and the audit dimension to that, I might just quickly talk about the timeframes involved, because again, I mean, there's been some commentary in the industry, but not a huge amount. I don't think many accountants are fully aware of it. The basic rule is, under the payment standards, once a member actually hands over a request to roll money to another fund, the trustees of that fund have 3 days to action that rollover. Now, there are some extensions you can get where you need additional information from the receiving fund, but generally it's 3 days. So you can sort of imagine this situation. I mean, not only are there issues about imagine a client ring up and saying, hey, look, my son wants to roll out, can you have these interim accounts done in 3 days time? I mean, the vast majority of us are, plenty of work, having to stop everything to do this, it's going to be very difficult. So you've got those types of issues about just getting the financials of the fund or the member balance of the fund in sort of a state where you can actually provide information to the receiving fund, 3 days. Then, quite separate to that, think about these self-managed super funds that have quite illiquid assets. Imagine a residential property, even commercial property. You can have this scenario where it's going to take months to effect this rollover, but the payment standards are very clear. You've got 3 days. Now, that's they are an area that auditors will have to focus on. Under Reg 6.17, it's something that we look at normally. So next year is going to be awful for us auditors. We will have to focus on this, and we'll have, where you have rollovers out, we'll have to ask the question: look, did the trustees meet these 3-day turnaround times? Now, how are accountants sort of solving this dilemma? Now, after they get over the initial shock of understanding this, what they're typically doing for those clients, for the majority, and this is the majority, where it's mum and dad, they're the members, they're also the trustees, and they've got templates, and they're basically saying, as a member, they're saying, hey, trustees, I'm thinking of rolling money over, please, but not at this stage, can you please get everything set up to do so? And then there's a second section on that declaration. Once the accountant said, yes, look, I've got everything here, they say, right, please, as of this date, here's my request, please roll this money across. And so there's actual evidence there that will satisfy Reg 6.17. So that's for the I guess the easy rollovers. Like I said, it's a bit of paperwork, it's hassle, it's red tape, but to be honest, it's going to be essential for these audits next year. Now, where you don't have one of those situations, and we had one, or involved in one about a week or two ago, where it was basically two different. It was two sets of mums and dads that had previously worked in a business together. No animosity, but one family wanted to roll their stuff over to another fund. They sent an email to the trustees. They said, the accountant said, yep, look, we want to get, we've bought, we're trying to buy something else over here. We need this money rolled across, and so they sent the email. So the clock starts ticking. You've got 3 days to get everything done. Now, fortunately, there was no illiquid assets. The accountant had to stop everything, get it all done, and so it all happened. But had they not done this, where there is actually a failure to meet that 3-day time, it was a $4,500 fine per trustee. it's just how it is. Now, I don't know how the ATO will actually enforce it, what their approach will be to it, but I have to think that a huge number of self-managed super funds won't be able to meet that requirement. So look, I guess the takeaway from that is, as accountants, look, be aware of these deadlines. Talk to your clients that are thinking about doing these rollovers to be aware of this. One idea that I've heard around the industry, I don't know if it works legally, is they're sort of making addendums to the deed or amendments to the actual trust deed rules to basically say that, look, if you want to do a rollover and we have illiquid assets, you have to give us 1 month's notice. Now, I don't know how that works with the SIS Act. I don't know whether one supersedes another. That's a matter for a lawyer, but that's what I've heard is happening. But look, so be aware of that in terms of the timelines and the deadlines. Now, going back to the examples, some real life examples of where where super streamers trip people up. We had a case a couple of weeks ago where very, very simple situation, very common situation. People go out and they're looking for property for a while. They finally find one, put a deposit on it, as a non-concessional contribution. They commit to buying that property. Turn around to the accountant and say, hey, look, we've got this property we want to settle on. Got 2 months to get, or a month to get everything sorted. Please go and organise everything. So accountant in a mad rush goes and establishes the funds and gets the tax file number and all the rest of it. And that all went fine. But then when they went to their industry fund to roll the money across, the industry fund said, no, there's a problem in the system. And so you sort of kicked off this exercise where the accountant had to go in and talk to the tax office and talk to the industry, and to try and work out where the errors were. And again, they were insisting, look, the problem's with you, it's failing. After many phone calls, and the ATO saying, no, Mr. Accountant, everything you've said is fine, it's all working here. And I said, well, look, let's go into our, they had, there's a communication thing that goes between the ATO and not so much the industry fund, but there's a database that sits between the industry fund. Let's go, was it Super Tick or something? And let's go and check that. So they ran the reports or ran the test, and that's where it failed. And what's transpired is that even though the industry fund had the right details and matched what the ATO had and matched what the accountant had, one of the data entry that had occurred in the industry fund when they were entering the data into the Super Tick database was wrong. There was something small that was wrong. We still don't know what it was, but as soon as that was fixed up, everything went through. Unfortunately, though, in the meantime, this person had committed to buying a property. So where we got involved is the accountant rang us up and said, look, we've run out of time. They need to get this done. They need to get this settlement happening, or they're going to lose a deposit. I think it was a Queensland property that, it's quite harsh. I'm just letting you know, the members are going to be lending money to their fund. What happens next? So you can imagine, it's a straight out breach. And I don't know what's going to happen. I mean, I believe they were going to go off and do the voluntary reporting of the breach, but they basically said, look, we don't want to lose our $50,000 deposit. So through no fault of their own, through this SuperStream sort of system, basically they were potentially going to lose this, $50,000. So I guess what I would be saying to accountants is advise your clients. Look, I mean, in the old days, it was okay to commit to a property and then set up the fund. I don't know if that still works. It may be, you might have to set up the fund, get everything ready, maybe even trial. I've heard one accountant said that in future, what he's going to do is line up all the ducks and, granted, he won't necessarily transfer the full amount of a member's benefit across into the new fund, or it just sits there in cash while the person looks for a property. What they might do is transfer $1,000 and just see if that actually works, just as a test. So be aware of that. This red tape is potentially going to get in the way of, doing these property purchases. Going the other way with a rollover out. Again, we had a similar sort of situation, and again, because accountants, we can't we don't know where an error happens. The scenario was, it was a wind-up. It was, 80-year-old fellow. He wasn't 100% health-wise. And so he transferred his entire life savings to an industry/retail fund. But because there's this elaborate system and essentially the money went across, or at least it left the super fund bank account. It took the industry fund 2 weeks to do their own reconciliations, whatever they do, to actually say, oh yes, look, we've received your money. So you can imagine how nervous and worried this poor fellow was, where his $1 million had just sort of been lost in the ether. And look, just on that note, one of the other issues that accountants have raised with us is that when you do these rollovers out, the way it works is that the ESA system will spit out basically the bank account details of the receiving fund. So the accountant has to give that to the trustee and get the trustee to actually make the payment. There's an element of risk in that, and so in the sense that theoretically that money can go into a wrong bank account. The accountant's given that information across to the trustee. So in order to remove that risk, accountants are saying to the trustee, ring up your receiving fund, confirm that these bank details are correct. And I would encourage everyone just to remove that area of risk off, from the table.
Well, actually, on that note, I think you raised some very interesting points about lessons learned. So perhaps we'll move forward to the Dixon Advisory and Melissa Caddick disasters. What are the lessons for SMSF accountants and auditors, and some practical steps that you can take to mitigate risk?
Yeah, sure. A little bit of spice in the morning session. So look, I mean, I guess these are the two interesting tales for the SMSF industry over the last year or two. The Dixon Advisory one, I mean, as I think most people that have sort of been reading the financial press are aware, is that essentially, their investments that had sort of basically they all went quite badly quite quickly, but the vehicle that was used for these investments, they were all done within the same Dixon's framework. They were essentially, there's one fund investing in another fund, and fees going on. They were never Dixon Advisory never told anyone to sell it, and essentially these things fell over. But the vehicle they were using for it was self-managed super funds. And because I'm Canberra based, and Dixons were very big in Canberra, we actually see the results of that. And look, my initial sort of thinking on this is that, look, there probably isn't much of a lesson for at least for accountants and advisors. I think there's huge lessons for financial planners, but for accountants and auditors, not so much. But look, I don't know if that's necessarily the case now. I had another good think about it, and with my sort of experience dealing with litigation matters and expert witness, I suspect that it's possible that some of these class actions, because there's about 3 class actions related to the Dixon super funds. I can see these highly rated lawyers trying to potentially having a go at the auditors and accountants through the investment strategy. I haven't seen the strategies that the Dixon clients had, but if the wording's not quite correct, it's entirely possible that the lawyers might, basically, the line they'll be sort of using is, hey, auditor, you didn't point out that this strategy is not quite right, that they talked about high liquidity when in actual fact these investments were not liquid at all. It's that sort of thing there. So I think, I guess the takeaway for accountants is, and particularly auditors, is look at the investment strategy, have a think about that as best as you can. I have a little bit of sympathy for these auditors. They sort of thought, well, they're listed on the stock exchange, they must be liquid. In actual fact, that wasn't the case. Now, the Melissa Caddick stuff. Look, this is, I'm guessing most people know, what that's about. In terms of what she actually did, maybe known, but essentially because we are actually seeing a handful of these funds come across to us. Fortunately, we had nothing to do with them before. I imagine there's a lot of worried auditors out there, but well, a handful of very worried auditors that were involved in this. And what she was basically doing is getting ComSec, dumbing up ComSec reports. I mean, you're tipping all the money in self-managed super fund, dumbing up ComSec reports, which you hand to the accountant, the auditor, and the members, and the auditors were just signing off on that. And look, just to clarify, some people don't think there actually were any audits done. That's not the case. She was actually giving those to professionals to look at, and they weren't picking up that they were sort of fraudulent. Now, this actually terrifies me because there's been occasionally when this came out, we had these moments where we wake up at 2 in the morning, go, oh, gee, how, as an auditor, how would you identify this? How would you solve it? And look, for ComSec, it's fairly straightforward. For broker type reports, it's, you can do HIN checks, you should be checking dividends. And to some extent, I'm a little bit puzzled why the previous auditor didn't do that. But, I guess the key thing there is that going forward, it's imperative that this additional audit work is done, if it wasn't done before, as it probably should. So, and it just goes to show you that, because you have to imagine that she didn't spend a lot of time doing this, and it was highly successful. So with broker type reports, I think it's, do that extra audit work, and it should be. What concerns me though, is that had she taken it to a different level, and instead of using ComSec, she was using some of those, portfolio type reports where everything is contained within the one set of reports. We have attempted to try and get HIN numbers, to try and do like checks of the underlying investment balances, but often we just can't do it, especially when there's a custodian in place. And right now we don't really have a solution, except when with data feeds are certainly useful in that area, but just pouring through the actual bank statements to just try and tie up some of the transactions. But it does represent a risk area, where fraud could potentially be successful. So yeah, it's a bit of a concern, Sasha.
No, I can understand why. And actually, on that note, we've had a few questions come in.
Okay.
I encourage the panel just to, or the attendees, just to shoot through questions either through the chat function or via the Q&A, and we'll do the Q&As at the end of the session. What we're also going to do is a poll at the end. So I know that Chris is touching on some quite contentious areas, which, when we were putting together this webinar, he was saying, each one of these could be their own session. So if you are interested at all in having a deep dive into the talking about, please just fill in the poll at the end so we can just gauge what your interest is. But moving on, now let's talk through director IDs and SMSF requirements.
Yeah, look, and I guess, there's not a tremendous amount to talk about with this subject, Sasha, but I guess in keeping with this sort of overriding theme of red tape and hassle, and just things that an accountant will have to just sort of grapple with over the next sort of 12 months. In the case of director IDs, over the next 6 months. Yeah, look, most accounts are fully aware of the need for director IDs, but I guess what we are seeing is that because everyone's just been so ferociously busy, this to some extent has been put on the back burner. And I guess including it in this webinar, it's more just a reminder to people that look, from was it 5th of April, you have to get your director ID before you even establish it. But the sort of the transition period, is coming to an end, and all the super fund trustees that are operating with a corporate trustee, that all needs to be sorted out by 30th of November. So look, I guess what I want to talk about with that is, look, there's 6 months of time which is going to go very quickly with a couple of big deadlines in there, and the process involved of getting those, as we've all discovered, it can be for some great, but what I've found is, particularly for trustees, older trustees and retirees that aren't necessarily IT savvy, it can be quite problematic. So yeah, look, I guess the takeaway from that is just a reminder, look, that's coming up. You'll have to dedicate some resources to it, because look, that whole regime is it's got strict penalties associated with it. So yeah,
indeed. So be it becomes a royal pain.
That's right. That's right.
Okay, well then let's move forward. Why don't we talk through the gnarly and gnarly rule and a bit of a review on that?
Yeah, look, I mean, I don't want to spend a huge amount of time into the technical details of it. I think most people are mindful of it, and I guess including it in there, I thought it was perhaps just a reminder to people to be aware that, look, I mean, even though there's still a tremendous amount of pushback and, but by our professional bodies, and a lot of professional bodies, and even though the government has said, yes, we will look at that, there's been no changes today. The regime that came out in the ruling has been finalised in that ruling. It's in place now. And look, we've had to deal with a couple of these over the last 6 months, and it's quite terrifying. Obviously, there are some related party dealings which you can solve fairly easily, like, for example, the related party leases and things like that. But the problem is, take for example these property development situations. And again, these trustees have tried to dot I's and cross T's, and but if for example you've got a so they've invested in a unit trust, bunch of super funds invested in unit trust, and they've actually got a related party builder involved in the process. The number of related party transactions as part of that is huge, and all it takes is one significant one, and that could be in a world of hurt. So again, I guess including that was just more of a reminder to people to be mindful of it. And look, I know of some cases where, when I've explained what the rules are and what the downside of falling foul of this is, these people have moved away from getting related party builders. And I don't know, maybe that's the intention of the ATO, I don't know, but the risks involved, or the potential big, and the additional paperwork. And I guess that's the thing too. Where you have related party dealings, the amount of additional, the additional sort of evidence that you need to ensure that you've actually met the rules is massive. Where there's a construction contract in place, well, you need to have evidence that the percentage, the cost plus margin you've used is commercial. You need to prove that the way the staged payments matches what happens in the real world. You've got to provide all this stuff where you don't need to do that with a third-party builder. So, yeah, I guess just a reminder to accountants, be mindful of this. And it is, I don't know, I think going forward, I think there's going to be a lot of instances where people get trip up on it and suffer quite heavily for it.
Fair enough. Yeah. Well, we're getting some great questions come through, so we might speed through this next section and then go to the questions a little earlier.
Sure.
So tell me if early engagement and voluntary disclosure service. Let's talk through that.
Yeah, no, look, we've had a couple of clients that have used that. I guess in the first instance, I'll just remind people that it exists. I think the ATO keep banging on the drum and saying, hey, you can do this. And look, it's always better to do that. Now, look, I mean, sort of scary for trustees where they've breached the act, and we've had quite a few of them. With COVID, people have lent money to their business just to keep their business afloat, or there's been early access breaches. And look, we don't know what the end result's going to be, but getting in touch with the ATO and engaging with them has been quite useful. And the feedback I've had from accountants is, look, it's not. It's been a positive experience for them. So yeah, in the first instance, look, just be aware that that's there. There's a link on the website that or a form that you can use to sort of raise a matter with the ATO. I will say though, you really need to have a plan to rectify whatever breach you've done before you actually go to the before you actually use that service. So, yeah.
Sounds good. Well, we might go to the question section. We've had a question come in. Is an SMSF allowed to have a debit card held in the name of a trustee offered by some cryptocurrency apps? For instance, crypto.com to take advantage of rebates on card purchases and higher cryptocurrency staking rates, as long as there is a deed of trust in place stating that the card is to be used for SMSF purposes only.
Yeah, look, I haven't had that one. I think the basic answer is yes, you could probably do that just from a legal point of view if there's a declaration of trust. However, and this applies not just this, but pretty much anything to do with crypto, you need to prove that you have to prove a whole bunch of things to the audit, for the auditor, and included in that is that the transactions are just for the fund, that the balances are actually exist. Now, for some of the what do they call the coin purses, they have excellent reports, and they to some extent can be relied upon. But where you don't have that supporting evidence, and it's a perennial problem with crypto type investments. It can be an issue for the audit, and at the end of the day, the ATO have got high standards for basically all these investments. Where you could end up with a situation where you might end up with a breach, and not necessarily you've done something wrong. It's more a case of as an auditor, we don't know whether it's something wrong because there isn't that audit evidence there. But the general sort of takeaway is yes. From a legal point of view, I think it works, provided that any benefits that come, those sort of discounts you're sort of referring to, go back to the funds, but it's all contained within the fund. So
okay, crypto is always an interesting one. We've had another question come in relation to the rise in managed accounts and information that's being made available, especially in relation to SMSF clients. How and what paperwork can be provided to the SMSF auditors as apart from the managed account reports?
Look, the internal audit reports,
the
internal audit reports that are sort of linked to those managed accounts are always important. And depending on who's actually running them, I mean, most big audit firms will actually have a depository of those internal audit reports. We've actually had to look at them to make sure it's all okay. But no, look, I think where you can get access to HIN numbers, again, that additional audit work that an accountant will want to, an auditor will want to do on the underlying investments, well, that will be useful as well. So yeah, look, I think that the managed accounts, the standard reporting pack plus the HIN or the CHESS details, if they're available, that should be fine. Yeah.
Okay, well, I'll then go to another question. Can an auditor refuse the unrealistic valuation by the real estate agent?
Yeah, absolutely. And this comes back to the auditing standards. There's no sort of imposition on an auditor. If a trustee hands over, and we've had instances like this, the trustee will hand over a ridiculous valuation that makes no sense, and the auditor considers it, but can reject it if it doesn't sound right. So yeah, absolutely. And I mean, look, and I guess it sort of goes back to having those that extra comparable data. I mean, and where this has cropped up in the past, like I said, it's been a real estate agent that just said, oh yeah, look, I think the value of this is X. And we don't know whether that real estate agent, I mean, we suspect he was like a maid to the trustee and said, well, what do you want it to be? We don't know. But having that's objective and supportable data, as the ATO say, just provides that extra oomph that will help with the audit. So yeah, but to answer your question, yes, we can refuse that valuation.
Okay, well, we'll just squeeze in a few more questions. We've had another question come in. Is the ATO discretion required for the tax liability of a payment after death paid from the deceased accumulated account paid after 6 months?
Wow, that's a highly technical question. Sorry.
So Chris, I've just put it because I know it's quite complex. Just put it in the chat function as well.
Okay.
Oh, sorry, I beg your pardon. Just bear with me for 1 second. Okay, that's come through to you now.
The ATO's question for the tax liability of a payment after death paid from deceased accumulation account paid after 6 months. not entirely sure what that question's asking. If you have a situation, a fund with a someone been deceased, and the tax liability. So the tax liability of a payment. I mean, a super fund, where the money's not going to its spouse and there's withholding tax to be paid. That just gets remitted to the ATO.
Perhaps in that instance, then, if Graham, if you want to just send us your email details, perhaps Chris can get back to you.
I think there's a. I think I know kind of what he's asked. It's probably quite a technical answer. So we can happily do that off stream. Yeah.
Okay, and time for one more question. Has an auditor been removed by ASICs for substandard valuations or investment strategies?
Gee, I don't know. We don't know because they. What do you think? Nothing springs to mind. I'm just trying to recollect whether they give very specifics. Let's face it, there's been a lot of auditors that have been struck off, as you've said, and they do occasionally give reasons for why that's happened. But in terms of insufficient audit, they'll where there's independence issues or cross referral issues, they'll talk about those. But in terms of the specifics of what they did about their audit that was deficient, I don't know whether they provide those sorts of details. I can't say. I would have to say that it probably isn't a big thing yet. I imagine there may be some. If auditors are messing up the valuations, they're probably messing up other things as well. So no, I can't say definitively, but it will definitely be. The ATO have really been focusing on this in the last 12 months. So I think it's a definite that they will. Looking forward, the auditors, if they are letting these things through, that will get referred to ASIC.
Indeed. Well, just before we wrap, as I mentioned before, we've got a poll that we'd love to and just get your feedback. We'll launch that now, and just perhaps take a moment, just if you could fill in your answers, would be ever so grateful. We're allegedly having a poll. Oh, confirmed, it's been launched. Fantastic. So just while you're answering that poll, Chris, just to wrap, what would be your key takeout from today's webinar for accountants moving forward?
Look, I guess the key thing I'd sort of say is, in the first instance, there's a lot of red tape and hassle and other stuff associated with that. In the first instance, try to be across that. And look, this applies not just to self-managed super funds, but across all sorts of aspects of running a business services practice. But there are definitely some for self-super funds. Be aware of what's required, and I guess have procedures and other things in place to try and make it as smooth an experience for your clients. With the aim that the audit process happens quite smoothly as well, because when that doesn't happen, it's just grief for everybody. That's the main takeaway. What this is about is just trying to make your lives easier, I guess.
Excellent. To that, Chris, I think that we've just received some feedback that there's no poll showing. So what we might do is we will send an email after this video, after the webinar. We'll give you all a copy of the video, and we'll submit the poll to you then for consideration. So what I would like to do is to take this moment just to thank all of the participants for coming today. We greatly appreciate the time that you've spent with us. And in particular, a huge shout out to Chris for providing such tremendous insights and speaking to camera for an hour, pretty much, on his own without any audience engagement is always very difficult. So again, feel free to stay on the webinar if you'd like to ask Chris any further questions. As I said, we will send through an email with all of Chris and his team's details for your reference, should you like to discuss your firm's SMSF requirements. And for now, good night, good luck, goodbye.